Hello and welcome back to The Note, coming to you again from the CFA Institute's annual conference here in Seattle, Washington. Today we're going to be talking about behavioural finance. It's been the subject of great research for two or three decades now, but one of the great criticisms of it is that it isn't possible to make much money out of it. My guest today does seem to have found a way to make money out of it, but perhaps the scary part of it is that it involves holding stocks where he doesn't even know the names of the stocks he's holding or the price which he paid to buy them. He's Tom Howard, founder of AthenaInvest. Tom, let's start with, how did you enter into this strategy? How did you go from looking at behavioural research to finding a way to invest in stocks?
Well, I started out believing in modern portfolio theory, but then the research turned decidedly against that. And then I began to look at different ways to consider managers and active managers. And then I began to read the behavioral science literature. And I was amazed how it dovetailed with the direction I was headed in terms of thinking about markets and how you manage money. And then we began to build out platforms and identify behavioral price distortions. And so that's where we are now in terms of managing our portfolios.
Now, there are various ways you can do this. As I understand it, you have identified what a good portfolio manager looks like, because obviously one of the great complaints is that there might be good active managers, but you can't tell in advance who they are. How can you tell a good active portfolio manager in advance?
You look at their behavior. How are they going about it? And the three things are...
Not their performance, right?
Not their performance. Performance is not predictive, but their behavior. Are they following a narrowly defined strategy? Are they pursuing it consistently? And are they taking high conviction positions? And we happen to have objective measures of all of those, but that's the key.
And obviously you've just described Warren Buffett, who's by far the most famous investor out there. But as I understand it, there are more. He might have high conviction, he may be consistent, but there are other non-Buffett strategies that will work.
Absolutely. We think there's hundreds of such strategies. In our database, we have all the active equity mutual funds, both U.S. and international, and we see hundreds of different ways of making money, and they can be successful if it's a narrowly defined strategy consistently pursued with high conviction positions.
Now, one other point that interests me is that, as I understand it, you can also identify bad managers and their worst holdings and make money from betting against those holdings. Is that right?
Yes, that was one of the more stunning results out of this research. So active equity mutual fund managers in the United States hold an average of 100 stocks, of which we know maybe 10 or 20 are best ideas. Right. Why do they hold the other 80 stocks?
Right.
And they hold it for institutional reasons.
Well, pre the rise of indexation, you wanted to be able to show that you got a broad basket.
Yeah, broad, and so we can actually identify the worst managers in terms of consistency and conviction, and then we can, through holdings, identify their lowest holdings, and those stocks actually underperform their index.
So there's money to be made, there's alpha to be made in the lingo by betting against them.
Yes.
You also manage a portfolio of your own, as I understand, applying these beliefs. Mm-hmm. How many stocks? Is it 10?
Yeah, 10 stocks. I managed it for 12 years. This particular portfolio has averaged 25% a year over this period of time.
Which includes 2 crashes.
2 crashes, yeah, exactly. And so it is what I call the poster child for behavioral portfolio management. It's a narrowly defined strategy consistently pursued with only high conviction positions.
Now, the one thing that bothers me, though, I went to see your presentation about this, and it was fascinating, but many people gasped when you said that you literally couldn't name the 10 stocks that are in your portfolio. Is it necessary to go to that kind of a length to avoid behavioral biases?
Not necessarily, but for my strategy it does. I mean, as I say, you ruthlessly drive emotions out of your investment process. So in other words, you root out everything that doesn't have anything to do with the specific things you focus on. And the name of the stock is irrelevant in my analysis. I needed to trade it, but other than that, it's not part of my analysis, so I don't remember it.
And similarly, you don't remember how much you paid for them.
That's right.
So that's to avoid loss aversion?
Loss aversion, there's all kinds of behavioral mistakes, cognitive errors you make when you know the price of the stock. This particular portfolio, we don't put any kind of trading loss restrictions on it. We don't put any caps on it. We're real fans of tail events. And so we'll have negative tail events, but the positive tail events are so much larger, and that's how we're able to generate those kinds of returns. If you know what you paid for it, then you're constantly reminded, well, I've lost 10%, I've lost 30%. I don't know. I just, that's not part of my strategy.
I suppose my final question is, how easy is it to sell these funds to clients, knowing that you don't know what the stocks are in there or how much you paid for?
This is our most successful product, and so it's grown very rapidly. Last year, it was the #1 portfolio in the U.S. in its category. It's one of the portfolios that gives you the chance for outsized returns, but you got to hang around. We don't know when that's going to happen. I don't know why 2013 was a particularly good year for it, but we know if you stay with us, keep playing this game over and over again, we can generate those kinds of returns.
Okay, Mr. Howard, thank you very much indeed. This was, I think, fascinating. It does suggest to me, first of all, that if you're going to be an active manager, you need to be a genuine active manager and make truly convinced bets. And it also suggests that behavioral finance, learning the lessons from behavioral finance, is easily described, but rather like value investing as well, it's actually very difficult to do.